50-year-old deal made in secret between Washington and Riyadh that most Americans have never heard of. It's the reason gas prices spike when a Middle Eastern country makes a move on the news. It's the reason the Federal Reserve has the power it does. And it's the reason your dollar has held its value as the world's reserve currency for half a century. It's called the Petrodollar system, and right now, for the first time in 5 decades, it is showing serious cracks. Since 1974, every barrel of oil sold on Earth has been priced in US dollars. That single arrangement has quietly funded your mortgage rate, kept inflation in check, and allowed Washington to borrow money cheaply. And Iran, yes, Iran, is one of the biggest reasons that system is being stress tested right now. In the next 10 minutes, I'm going to show you exactly how the petrodollar system was built, why it's cracking, what Iran has to do with it, and most importantly, what this means for your money right now. No jargon, no doom and gloom, just the facts, laid out clearly. Let's get into it. To understand why this matters today, we need to go back to 1971. President Nixon made one of the most consequential financial decisions in modern history. He ended the gold standard. No more trading dollars for gold at a fixed rate. The dollar was now a pure fiat currency, backed by nothing but trust in the US government. The problem? Without gold backing it, what gives the dollar its global power? The answer came 3 years later, in 1974. In a deal that wasn't fully declassified until decades later, the US and Saudi Arabia reached a landmark agreement. Saudi Arabia would price its oil exclusively in US dollars. In return, the US would provide military protection and buy Saudi debt. This created what economists call petrodollar recycling. Every country in the world that buys oil has to hold dollars to pay for it. That creates permanent structural demand for the US dollar, demand that has nothing to do with how well the American economy is performing. It's demand baked into the global energy system. Now look at this chart. Today, the US dollar still makes up roughly 58% of global foreign exchange reserves, according to IMF data. No other currency is even close. The euro is at 20%, the Chinese yuan under 3%. The petrodollar is the reason for that gap. And that gap is exactly what's being threatened. So where does Iran come in? Iran has been selling oil outside the dollar system for years, accelerated dramatically after the US reimposed sanctions in 2018. To survive economically, Iran developed alternative payment rails, yuan-denominated deals with China, barter arrangements with Russia, bilateral oil trades with India using local currencies. But here's the bigger picture. Iran didn't just find workarounds to survive sanctions. It became a proof of concept. It showed the world that large-scale oil trade outside the dollar system is actually possible, and other countries were watching. In 2024, Iran formally joined the BRICS bloc, the economic coalition of Brazil, Russia, India, China, and South Africa. That bloc has been openly discussing building alternative payment systems, and even a shared currency for cross-border trade. Look at this correlation. As non-dollar oil trade has grown, slowly but consistently, the dollar index has shown periodic weakness. Now, correlation isn't causation, but the direction of travel matters. Iran plus Russia plus China are now a triangle of dollar bypass behavior, and they're actively building the infrastructure to make it permanent. The question is, how much does that cost you? Let's be direct. If oil stops being universally priced in dollars, less of the world needs to hold dollars. Less demand for dollars means the dollar weakens. A weaker dollar means imports cost more. And when imports cost more, from electronics to clothes to food, inflation doesn't just come back. It gets structural. It gets sticky. This isn't abstract. If the dollar weakens meaningfully over time, the Fed has to keep rates higher to defend it. Higher rates mean your mortgage costs more, your car loan costs more, small business borrowing costs more. This is how a geopolitical arrangement made in 1974 shows up as a line item in your monthly budget 50 years later. History gives us a template. After World War II, the British pound slowly lost its status as the world's reserve currency. It didn't happen overnight. It took decades of accumulated pressure, war debt, weakening trade position, and the rise of the U.S. economy. But once the tipping point hit, the decline was fast and painful for British citizens. Their purchasing power dropped. Their cost of living rose. Sound familiar? Now, I want to be clear. The U.S. is not Britain in 1945. America still has the world's largest economy, the deepest financial markets, and the most trusted military. The dollar isn't going anywhere tomorrow. But the direction of travel, slow erosion, not sudden collapse, is exactly what smart investors protect against. First, let's set the right frame. This is not a dollar collapse story. Reserve currency transitions historically take 20 to 40 years. The dollar's share of global reserves has already declined from 72% in 2001 to around 58% today. That's a slow, steady drift, not a cliff edge. What smart money prepares for is not the worst-case scenario. It's the base case: continued, gradual erosion of purchasing power. The strategy that has historically performed well during dollar weakness cycles is what some advisors call a barbell approach. On one side, stable, income-generating assets, dividend stocks, short-duration bonds, real estate. On the other side, a small, deliberate allocation to inflation hedges. Historically, that has meant commodities, energy sector equities, gold, or Treasury inflation-protected securities, TIPs. Energy stocks in particular deserve attention here. If oil trade increases across multiple currencies, the underlying demand for oil doesn't disappear. It actually grows as more countries access it more efficiently. Global energy majors priced in dollars can benefit from both the commodity price and the currency differential. One thing to actively avoid: panic-driven speculation. Every few years, someone declares the dollar is dying and sells you a dramatic alternative, usually some cryptocurrency or exotic asset pitched as the new reserve currency. That's not analysis, that's a product. The petrodollar shift is real and worth understanding, but it plays out over decades, not quarters. The bottom line is this: you don't need to make dramatic moves. You need to make informed ones. Here's the real takeaway from today. The petrodollar isn't dying tomorrow, but it is changing, slowly, structurally, and in ways that flow directly into the price of everything you buy. Understanding that mechanism puts you ahead of 95% of people who will only notice it when it shows up in their grocery bill. If this kind of no-noise financial breakdown is useful to you, if you want to understand the systems behind your money, not just the headlines, hit subscribe. We do this every single week. No hype, no predictions, just the signal. Do you think the US dollar will still be the world's reserve currency in 25 years? Drop your answer below. Yes, no, or it depends, and tell me why. The best answers get pinned. I read every single comment.